So the world is getting poorer. In 2022 alone, over 250 million people were pushed into poverty. And the possibility of a global recession has put countries around the world on high alert.
Economies the world over are contracting. Their economic forecasts are shrinking.
Third of the global economy will be in recession this year.
I don't think it's going to be a very happy year. We are expecting the economy to slip into recession.
The worst is yet to come.
In spite of the uncertainty created by the pandemic and war-triggered inflation, China and India have emerged as the second and third largest startup ecosystems in the world, next to the United States, which is number one. With a combined population of more than 2.8 billion people, China and India make up more than a quarter of the global population. They both have booming domestic consumer markets, thriving middle classes, and strong skilled workforces, and exciting startup ecosystems that hold tremendous potential for global investors. Now, back in 2020, we actually made a video comparing these two countries' startup ecosystems, but so much has changed since then in the world and also in India and China. And so this video that you're watching right now is an update, a 2023 comparison of India and China's startup ecosystems. And let's dive into it right after this. So in the last decade or so, China, which many people still refer to as the world's factory, has slowly been weaning its economy off of manufacturing. And what they've been doing is diversifying into tech, with BATS leading the charge. That's Baidu, Alibaba, and Tencent. In fact, Chinese society is now so reliant upon Tencent, specifically for WeChat, that when users get kicked off of the platform for violating its rules, their lives actually fall apart. They end up writing heartfelt apologies to the company, begging to be let back into the super app. But WeChat and other tech innovations didn't happen overnight. China's startup ecosystem has taken a decade to get to where it is today with the help of the Chinese government, large corporations, universities, and local and international VC firms. And specifically talking about that last one, VC firms, Chinese startups raised a whopping $130.6 billion in venture capital in 2021, which is 3 times more than the $42 billion that Indian startups raised during that same year. So definitely a point in China's favor. Now, let's talk about India for a second here, because while its startup ecosystem may not be as big as China's in terms of access to venture capital, it is the third largest startup ecosystem in the world. And specifically, 2021 was a watershed year for this ecosystem. It was a period of immense and unexpected growth, with 46 companies becoming unicorns in just 12 months. What's more, fundraising cycles that used to take years shrunk to just months, allowing startups to raise successive rounds and grow faster than ever before. And yet, the $42 billion that Indian startups raised in 2021, which was the best year on record for Indian venture funding, was more than $15 billion less than what Chinese startups raised all the way back in 2015. And just to take you back to 2015, that was the year that Apple launched its very first Apple Watch. Yeah, ancient history. So China obviously has a very mature startup ecosystem, while India's does have a couple of years of catching up to do. But with the right government policies, a young population compared to China's aging population, global aspirations, inexpensive internet access, and the massive potential of what many VCs and startup founders refer to as the next 500 million, which is the TAM that a lot of tier 2 and tier 3 focused startups target, it's very possible that India will catch up with China sooner than most of us expect. With a total of 105 unicorns, India today has 4 decacorns. That's companies that are valued at more than $10 billion. These companies are Flipkart, Baidu, Swiggy, and Nykaa. And I've personally been in India to witness each of these companies become decacorns, which has been an honor and a thrill for me and the Backstage with Millionaires team. That being said though, if we take all 4 of these companies and combine their valuations, they're actually still less valuable than China's single most valuable hectacorn, ByteDance, which is known for its flagship short video sharing app TikTok and is currently valued at a whopping $300 billion US. So comparing India's most valuable unicorn, Flipkart, valued at $37 billion and targeting between $60 and $7 billion for their IPO, and China's most valuable unicorn, ByteDance, it immediately becomes clear that China is leaps and bounds ahead of India, at least in terms of their most valuable startup companies. And the other unfortunate thing about Flipkart is that it's owned by Walmart, an American company. So while it is technically Indian in origin and it does serve the Indian market, that's its customer base, most of the actual value of this company company is in American hands. ByteDance, on the other hand, serves a global user base. Except for India, Afghanistan, Syria, and China, it's more or less ubiquitous worldwide. And yes, I do say China because people in China aren't actually allowed to use the app. Instead, they use a Chinese version called Douyin, which is basically the same app as TikTok and is also owned and operated by ByteDance, although it's heavily controlled and censored by the Chinese Communist Party. And this opens up a wider question about the ownership of ByteDance and the rest of China's tech companies. Flipkart is owned by Walmart, but ByteDance's ownership isn't clear. Yes, they have raised upwards of $9 billion from investors, local and international, but how much control do those investors actually have over their China-based portfolio companies? It's hard to imagine international stakeholders voting against the desires and agenda of the CCP. The government of China just wouldn't allow it. So when your vote as a stakeholder doesn't matter, do you really own a piece of that company? This ambiguity and uncertainty is a point against China. China's second hectacorn, which is worth more than $100 billion, Shein, is the world's largest fashion retailer. It's present in over 200 countries and enjoys immense global popularity, but is again banned in India on grounds similar to those of TikTok. The government of India doesn't trust that these Chinese apps, platforms, and services will protect the data of Indian citizens the way that they want them to. And instead, they think that it's very likely that these apps will instead just do whatever the CCP tells them to do, which would likely involve handing data straight to the government of China, giving it a clear view into how Indian consumers behave and what they care about. What's more, India wants to protect local businesses. Shein would be a direct competitor to Myntra and other Indian e-commerce fashion platforms, and even though Shein products are now available in India via Amazon.in, the company's reach and data collection abilities have been stunted by the government of India's protectionism. And it's the same thing with TikTok. Thanks to protectionism, startups like Moj, Mextokatok, Chingari, and Josh have been able to thrive. That being said, though, the same thing can be said about China. They've done very well for their local ecosystem by protecting it from outsiders who might try to monopolize Chinese industries. Good examples of this are American companies like Facebook, Google, and Dropbox, which have all been banned from operating in China. Other companies like Tesla, Apple, Starbucks, and Nike have a very strong presence in China, but they're also very careful to play by the CCP's rules. They know that if they start to implement anti-competitive behavior, or if they start to collect and sell data, then they'll promptly be kicked out of the country. And so when it comes to protectionism, both India and China get a point. Now, I want to zoom out here for a second because China is without a doubt the winner when it comes to valuations. ByteDance and Shein are just two of China's 301 unicorn companies, and just these two unicorns alone have a cumulative valuation of more than $400 billion, whereas India's 107 unicorn companies combined are worth just $340 billion. So that's definitely a point for China. That being said, though, India is minting unicorns faster than China. And if you look at this graph, you can see the rate of growth amongst unicorns in India, 36% growth from 2019 to 2020, and over 100% growth in 2021. And this has slowed down a little bit in 2022 because of the entire economic slowdown in the global economy. And if you take a look at China's growth, 8% growth in 2020 and just 14% growth in 2021, India is clearly ahead. And according to INC42's The State of India Startup Ecosystem report, India will beat China to become number 2 in terms of total number of unicorns by the year 2025. So this speed of unicorn production is definitely a point in India's favor. But where are India and China's unicorns coming from? Which industries are leading the charge? Well, let's take a look at this chart. So e-commerce is the obvious winner in India with a cumulative company valuation of $85 billion. And some of the leaders here are Flipkart, Meesho, Nykaa, and Cars24. And it's also worth noting that unicorn house of brand startup Mensa Brands and GlobalBees took 6 months and 8 months respectively to achieve unicorn status. Now, e-commerce is followed by fintech with 21 unicorns and $64 billion of value, with giants like Paytm, Razorpay, PolicyBazaar, and PhonePe as the leaders. And then we have enterprise tech, and most of this value is in the SaaS space, with companies like Keka, Zoho, and Freshworks taking India's international tech presence to new heights every single year. Now, for the sake of being honest and realistic here, I should note that these top 3 Indian sectors combined are worth less than China's top performing sector, fintech, which is worth over $227 billion. And the leaders here are Alipay, which is owned by Ant Group. You also have WeChat Pay under Tencent, and MyBank, which is also underneath Ant Group. Fintech in China is followed by internet businesses with companies like the Bats, that's Baidu, Alibaba, and Tencent. And Baidu is basically China's Google. Alibaba is known primarily as an e-commerce platform, but also as a subsidiary Alibaba Cloud, which could be compared to Amazon's AWS. However, they also have the added functionality of AI-powered facial recognition and surveillance software configured to detect ethnic minorities, including Uyghurs, which would obviously be a very lucrative business within China itself. But if this technology were sold to other countries with an interest in racist computer vision, then Alibaba may be able to significantly grow Alibaba Cloud. And just to be clear, it's not known whether this tech has ever made it out of R&D or if it's ever been brought to market and utilized in real-world scenarios, but Alibaba did offer Uyghur detection as part of its content moderation solution in an API guide. And then we also have Tencent, a social media giant that owns popular apps like WeChat and QQ and also makes games as well. The third largest sector in China is logistics, with more than 1,600 startups and a valuation of over $123 billion US. But there's a couple of other sectors that I want to take a look at as well. China's EV, AI, and deep tech spaces are really advanced. And just as an example here, Chinese EV maker BYD has already sold 550 EVs in India and is in rapid expansion mode here as it's aiming to become one of the top 3 players in India in the passenger EV segment by 2030. That being said though, India too has made some pretty great strides in specific sectors like, for example, biotech, agri-tech, and the EV spaces, and these are extremely critical to India's future economy. And we've actually made detailed videos on each of these 3 sectors that you should definitely go check out. So we've established at this point that China and India are number 2 and number 3 respectively when it comes to startups globally. But on a more micro level, where are these startups coming from? Which cities are generating China and India's unicorns? Well, let's take a look. Here's a map of India, and you can see here that most of the companies with valuations upwards of $1 billion are located here in Bengaluru, followed by Delhi NCR and Mumbai. In China, on the other hand, a lot of the startup hotspots are located along the East Coast, with cities like Beijing, Shanghai, and Shenzhen leading the charge. So Beijing is known for its booming artificial intelligence, big data, and fintech startups, and about 70% of the country's potential unicorns are located here. Now, the closest India equivalent to Beijing would be Bengaluru, which has a mix of sectors ranging from e-commerce to fintech to agri-tech to EVs. Beijing is followed by Shanghai, which is home to the highest number of Chinese e-commerce, transportation, and education startups, and then coming in at number 3 in Chinese startup hotspots, we have Shenzhen, renowned for its telecommunications, hardware, and EV startups. In India, on the other hand, Bengaluru is followed by Delhi NCR, which has actually recently overtaken Bengaluru in the number of newly recognized startups. After Delhi comes the financial capital of India, Mumbai, and it boasts a number of e-commerce, fintech, and IT startups. And then the rest of India's unicorns are spread out across cities like Hyderabad, Chennai, and Gurugram. And one piece of good news for Indian startups is that Bengaluru and Delhi have jumped up in their rankings on the global startup ecosystem list, with Bengaluru moving up 1 rank to the rank of 22, while Delhi now ranks at 26. Chinese startup hotspot Beijing's position, on the other hand, actually dropped from 4th to 5th in the global rankings. And it's not just Beijing. 8 out of the 13 Chinese startup cities that featured in the top 50 list also fell in this year's rankings. So the question that we need to be asking here is this drop due to the prevailing global situation, or does it point towards something more profound? Well, to give context here, China has always been a favorite for unicorn-seeking VCs. In the last decade, the Chinese government has set up startup-focused funds, which they call guidance funds, and they're using this money to fund early-stage startups left, right, and center. China also has 11,000 startup accelerators and incubators, compared to India's mere 520. And moreover, through programs like the Open Door policy, the Chinese government has aimed to encourage foreign businesses to set up offices and do business in China. This positive, growth-friendly sentiment of the Chinese government enticed the biggest names in venture capital to invest billions into Chinese startups and companies with a promise of great returns. And this helped to mint billionaires and giant tech companies at a breathtaking pace. See, last year, the Chinese Communist Party, the CCP, started a massive crackdown on tech giants, education companies, and entertainment firms in order to pursue the ideology of common prosperity, which seeks to narrow the stubborn wealth gap between the rich and the poor. The idea here is to maintain social stability and weed out any company or person that is perceived to be a threat to that. So, for example, Alibaba and its founder Jack Ma have been targeted by the Chinese government for alleged monopolistic conduct in e-commerce, and they were fined $18.2 billion as a penalty, the largest regulatory fine imposed on a Chinese tech company to date. Similarly, Didi Chaojing, China's biggest ride-hailing app, has been banned from signing up new users and was also fined $1.18 billion just days after it saw a blockbuster listing on the New York Stock Exchange. These crackdowns by the government of China have already wiped out $1.5 trillion in market value in 2021 and left investors from around the world terrified of losing their multi-million-dollar investments in the blink of an eye. Another factor that was ringing alarm bells amongst investors was China's zero COVID policy, where the government had put a halt to all economic activities to stop any community spread of the coronavirus. This draconian measure saw factories shutting down and shipping delays disrupting the global supply chain, and this in turn led to a reduced business confidence amongst venture capitalists, making China less appealing as a lucrative destination to invest in. And then there's also the Chinese government reshaping the pop culture narrative by taking down the accounts of tens of thousands of celebrities, bloggers, and influencers that it deemed to be immoral for reasons ranging from misuse to not promoting core socialist values. Really, the principle that China seems to be following right now is banning all Western-aiming startup growth culture and killing it to safeguard its communist ideals. So China definitely has a lot on its plate right now, and due to all these crackdowns and regulatory clashes, it's become one of the worst performing VC markets of 2022. India, on the other hand, is slowly replacing China as a preferred destination of investment for Western firms. The China Plus One strategy, where the world is looking for another place for manufacturing, is also set to help India massively in the coming years. Apple, for example, announced this year that they'll be manufacturing their iPhone 14 in India, and by 2025, the company plans to manufacture a quarter of all of their iPhones in India. Other than that, companies like Nike, Adidas, Samsung, and LG have also moved a significant chunk of their manufacturing to India. So in terms of global perception, India is certainly ahead. It's being viewed as the next growth engine for the world's economy, and the government of India is also playing a key role in all this. Its efforts towards easing regulations, providing good infrastructure, and promoting entrepreneurship across the country through programs like Atmanirbhar Bharat, Gati Shakti, and Startup India are starting to show results. Ultimately, if we put India and China side by side and compare on each parameter as we've done in this video, then yes, China is still ahead in most of these categories, but the pace at which India is closing the gap is really impressive and exciting. And who knows, by the time that we make an update on this video in a couple of years, India might have surpassed China in many of these fields. Now, if you haven't already watched the 2020 version of this video where we compare India and China's startup ecosystems, then I would highly recommend that you check it out. You can find it right here. And thank you so much for watching this video. I'll see you in the next one.